Chapter 3, Part 1, the Accounting Cycle. This will be a refresher for those of you who have not taken accounting for a while, so this is a good review for you. The accounting formula. Assets equal liabilities plus equity, and we must always be in balance. Now let's look at some accounting terminology to refresh your mind. First, we have an event. This is something that happens in a company, and what we need to do is focus on those that are financial transactions. An account is where we collect all of the financial data for a specific type of transaction, like cash would be a good example. We talk about real and nominal accounts. Real accounts are on the balance sheet. Nominal accounts are on the income statement and also include dividends. These are any accounts that are zeroed out at year end when we close. The ledger. We have the general ledger. This is where we keep all the information on all the individual accounts. A journal is the original entry. It shows it's chronological by date, and it shows both sides of the entry, and it should reference any document or source document as a basis for that journal entry. Once we make a journal entry, we then post that information to the individual accounts in the general ledger. We journalize in the general journal. Trial balance. This is a listing of the balances from the general ledger of all of the active accounts, and there are 3 of these: unadjusted, adjusted, and post-closing. Adjusting entries. Because we have the revenue recognition and expense recognition principles in accounting, we must do accrual accounting. So because of that, at the end of each month, we must do adjusting entries. Then, based on an adjusted trial balance, which is run after we do the adjusting entries, we prepare our 4 financial statements. And then at year end, we do one more thing. We close the books and we transfer all the balances from nominal accounts to retained earnings. Now again, the accounting cycle. We start by analyzing transactions, and if they're financial in nature, we're going to journalize, then we're going to post, then we're going to prepare that unadjusted trial balance to make sure that all of our accounts have a normal balance and that our debits equal our credits. We're then going to do adjusting entries to make sure we've recorded all of the revenue and all of the expenses. And then we're going to prepare an adjusted trial balance, which we're going to use to prepare our financial statements. At year end, we're going to take one more step, and we're going to do closing entries. And once we've done that, we're going to prepare a post-closing trial balance, which should only include permanent accounts. Financial transactions. These are events that have a financial impact on the business. They have 2 sides, giving and receiving. Accounting records records both sides of the transaction using debits and credits. Debit and credit rules. Debit and credits are neutral terms. They are not good or bad. They mean either decrease or increase depending on the type of account. So now let's go through the rules of debit and credit. An asset, we increase with a debit, we decrease with a credit. Liability accounts, we increase with a credit, we decrease with a debit. Stockholders' equity. If we increase stockholders' equity, we're going to increase common stock with a credit and decrease with a debit. Retained earnings, we're going to increase with a credit, and decrease with a debit. And revenue, we're going to increase with a credit and decrease with a debit. Now, dividends and expenses decrease stockholders' equity, so they're going to be the opposite. An increase is a debit, a decrease is a credit, and for expenses, a increase is a debit, and a decrease is a credit. Now, how you determine normal balances, so when you look at the balances to make sure everything's okay, is it all is based on how you increase that account. So, for assets, the normal balance is a debit. For liabilities, common stock, retained earnings, and revenue, the normal balance is a credit. And for dividends and expense, the normal balance is a debit. Debits and credits, again, a rehash of that. To increase with a debit, it would be assets, dividends, and expenses. Credits will increase liabilities, revenue, common stock, and retained earnings. Make sure you understand this well, because you need to understand this whenever a financial transaction occurs. The first thing you're going to figure out is, what is it? Did it go up or down? And that's going to determine what you debit and what you credit. Now, when we journalize in the general journal. And when we do that, we're going to write the account debited first and the amount in the left column, and write and indent the account credited next and the amount in the right column. And the debits must equal the credits, and we would also reference our source document. Posting. This is in the general ledger, and it's the collection of the accounts and their balances. And we do this when we transfer information from the journal to the ledger to the individual accounts affected. So at month end, we can figure out how much cash we have, how much equipment we have, and various other types of accounts. The journal process. So now we're going to go through some journals so you can hopefully help you remember how you do it. So first, we were prepaid $25,000 to provide future services. What this means is someone gave us $25,000 in cash to do some work for them in the future. So we know that we've got cash, which is an asset. It went up, so we're going to debit it. And we know that since it's for future services, we haven't done the work. This would be unearned revenue, and unearned revenue is a liability account. So it went up, so we're going to credit it. Next, we purchased $1,000 of supplies on account. Supplies have future economic value, so they would be treated as an asset, and they would have gone up. But because we didn't pay for them, we've created a liability, accounts payable, which went up, which means we would credit it. The next thing that happened is we performed $10,000 in services. We received $5,000 in cash, and the balance is to be paid in 15 days. So first, what we're going to do is what was affected. Well, first, cash was affected by $5,000. It went up, so we debited. But since they didn't pay us all the money, and now they owe us money, that becomes an accounts receivable, which is an asset, and it would have gone up, so we debit it. And now we have done the work, so we've generated revenue. To increase that, we would do a credit. Now, once we go through this whole process, at month end, we prepare an unadjusted trial balance. Again, for the unadjusted trial balance, what we will see is we will check to see, do we have normal balances for all of our accounts? Do our debits equal our credits? Now, with automation, usually the debits will equal the credits. However, we do need to make sure that the balances are normal. The other thing we're going to do is look to see, have we consumed any of our assets, earned any of our unearned liability, or have we booked all of our expenses and booked all of our revenue? And that's what we use this unadjusted trial balance for. So the next thing we can do is prepare adjusting entries. Again, these are required because of the revenue and expense recognition principle. They never involve cash. There are three types. Deferrals. These are assets or liabilities that are already on the books, and if they're assets, we've consumed them. If they're liabilities, we've earned it. Accruals. They're not on the books at all, so what we're going to do in that case is we're going to put them on the balance sheet and put them on the income statement. Depreciation, amortization, depletion. What we're going to do again is look at our balance sheet to see, do we have to allocate any of those items, assets, over time as we consume them. Now let's look at the journal process. We had office supplies of $500 were consumed of the $1,000 that we originally purchased. So what we're going to do is we're going to book an expense because we've consumed it and reduce an asset. Now for that unearned revenue, which is a liability, we now have earned 10,000 of it, so we're going to reduce a liability and increase revenue. Next, we have, so the first two we talked about were deferrals. They're already on the books, but they're moving from the balance sheet to the income statement. The next thing that we're going to talk about now are things that are not on the books at all. These are accruals, and in this example, we have $600 in salaries that we owe employees that are not on the books, so we need to record the expense and set up a liability. The other thing that we need to do is book depreciation on our assets. So if $1,500 is for the month, we're going to book the expense called depreciation expense and set up the contra asset account called accumulated depreciation. Now we would prepare our next trial balance called the adjusted trial balance. This is the trial balance that we use to prepare the financial statements. In part 2 of chapter 3, we will talk about that.